we do have a special guest with us today, Bruce Fraser. He is now a professor on the Wyckoff approach. And who better to learn from than Bruce? Welcome back to the show, Bruce.
Good to be back. So I celebrated my 30th year of teaching technical analysis in Wyckoff last year.
Congratulations!
30 years. So it's this is kind of fun for me. As a matter of fact, I was thinking about today's topic, which I promised last time that we would talk some about distribution, and because we've done the trading cycle, so we've done accumulation, we did reaccumulation or the markup phase. So now we're going to do some distribution a little bit. I think distribution is important because not only is it important to people that like to short, but it's very important to people that want to be able to exit long positions they've held for a long time in a timely way. And so this really is an important topic for everybody. Okay. So here is accumulation. And what we're going to talk about with distribution is going to look a lot like this, but it's going to be flipped upside down. So it's going to be the reverse of this. So this is the process that we go through to develop or accumulate shares. And we talk about that, the mysterious composite operator who is accumulating shares across a range. And here is a range-bound market. And these are just two different, really, examples of the same thing with slightly different looks to them, but really they're doing effectively the same thing. So I'm not going to spend any more time on this, and of course you're welcome to go back through the blogs and look. So here, this is the schematic we're not going to talk about today. But you can see it here in this blog, and so the notion is that after a big long uptrend, we have a crescendo of like a buying panic, which we call a buying climax. And then after the buying climax, we get what we call a change of character, which is a big, deep, sudden, sharp correction, typically on volume. And this is like, if this is the only thing we get out of this conversation today, this is like worth everything. And this will keep your cash in your computer. The buying climax is where the resistance is going to form from here on across. So we draw a resistance line right at this peak. And then, and typically we do that once the automatic reaction is in. And so once we have the buying climax and the automatic reaction, we start to turn off of that. We draw resistance, we draw support, and we then watch for the market to trade in these reflecting barriers for some period of time into the future. It's really exactly the same thing we're doing with accumulation, but like I said, we've flipped it over. There's a really distinct difference between what happens during accumulation and what happens during distribution. And so these are the characteristics of phases. So each of these phases has a different characteristic of trading. And this is the behavior of price and volume together. So phase A is the stopping of the advance, big correction, sets the range. Phase B is where, and this is the narrative that we tell ourselves, is that the composite operator, the really smart, really big money, is using this phase B area, which is just this very volatile sideways trading area, to systematically distribute the stock that they were long all the way up. And so they're using this period in here to carefully, stealthily, to sell the stock here, because this is the place that they have decided to release these shares to the public and to other lesser institutions. And so the thing is that the reason that we have this cap on the upward direction of prices is because of the huge amount of supply that the CO is putting over the market. And they're very careful how they do it. They never trade against themselves. They're not going to drive prices down unnecessarily, but what they're going to do is they're going to use the rallies to systematically release stock to the market, And when the reactions come in, they're going to stop, and they're going to wait until they get another rally. And so they can sell a tremendous amount of stock here, here, here. And then once we get to here, something changes. So phase B is where all of this work is being done. Phase C is the final testing area where the market is now been literally filled up with stock by the CO, and they no longer hold it. And the key to a successful uptrend is to have really large CO types campaigning the stock, sponsoring the stock as it goes higher. Once they are done selling, they no longer are sponsoring and campaigning the stock. They are the important source of buying for that stock. And when they no longer have any, or they may even be short, then they literally abandon this market. And the bids go away. The supply is all been released, and then the market is in a position to just go into a big downtrend. And typically these are very wicked downtrends. Now, the thing about this is that when you have this kind of a situation, there's something that occurs differently in distribution than occurs in accumulation. And that is, in distribution, the market becomes more and more volatile as you go further in to the distribution area. So here, this is accumulation. The CO types are absorbing shares. They're literally removing shares from the marketplace where they buy them, making them no longer available for trading or for buying, and the stock becomes scarce. Now, we can't see that. We can't see the scarcity other than through the characteristics of price and volume. Well, here we have the characteristics of price and volume showing us ever greater degrees of volatility before the stock or the market can go into a downtrend. Okay, so here we go. This is what we're going to talk about today, and I'll try to go a little faster. So all the characteristics are here, and there's a reason I'm going to focus on this particular schematic today. I have a reason for that, and that is that here we have the stopping action of phase A. Everything's just like it was on the prior schematic. We have a big, wide, volatile trading area in B, where stock is being released by the CO. Phase C, the primary difference is this is the final test before the downtrend is effectively beginning. Phase C is its final testing area. It makes a new high. So notice this, a high, a higher high, a higher high, downtrend. Now, how nasty is that? That's just cruel. So here we are, happily holding our stocks, watching them go to higher highs, and the whole time there's these strong hands that are basically selling their shares. And so, yeah, go ahead.
Would you say that final high especially is going to be on relatively light volume since the buying is drying up?
Yes, but you could have, good question, because you could have a big spike of volume at the highs. And then volume will tend to expand as it comes off the high. So this volume propelling this upward is low. And that's because the CO is basically not releasing stock to the market on this rally. And so they know that the market just can't handle a lot of stock selling here. So they literally just stop their selling campaign. They will sell up here, and then they will sell on a scale down off the peak, and the volume will expand.
Bruce, I'm getting a lot of questions, and I don't know if you're going to cover this as you go, but most people, of course, are interested in, what phase is, the S&P or the market in general in, are we seeing, what kind of a period are we looking at this chart with phase?
Sure. Well, I believe that we have just completed a buying climax and automatic reaction. So quick answer, maybe we can come back and look at some more charts, but that huge decline that occurred in the beginning of February, remember that January, the whole month up, was just a monster. And it was January was a climax month. That's the way I'm thinking of it, because it just went like this, up and up and up and up. And then February, bang, we had this huge outsized reaction. A lot of volume, a lot of volatility. This is exactly what automatic reactions look like. So I believe that we're in now we're rallying off of that. We're getting close to the old highs. This secondary test could actually go to a new high. May or it may not. And then back down to the lows or getting near the lows. The thing is that you could go down, make a lower low or make a higher low. It doesn't change the basic picture. So I believe that we are still in this phase A period.
Okay.
Now, that doesn't mean this is distribution, because remember the last time we talked about reaccumulation. So it's conceivable that but here's the thing, and this is why your question is so important, because when we're here, we know that we're in a range-bound situation, but we're going to need to see more trading to be able to tell whether absorption is occurring, which will allow the market to put on another leg up. And if absorption is not occurring, and in fact it's becoming ever more volatile, then we would start to brace ourselves for the idea of distribution across the broad averages. Yeah, so this is the cool part. So here, when you stop a market that's going to go higher later, it looks the same as stopping a market that's getting ready to distribute. So another cruel thing. So here is an example from a blog, and the reason that I'm putting up this example is because I want to demonstrate that you can use these tools on a short time frame. You can use them intraday, you can use them daily, you can use them weekly, whatever your preference is. These tools can work for you. So here is a real life example that I put up as a blog post. It's called, it's from a few weeks ago, called Apple Pie, I think. So you can go look at this chart, and I have a point figure chart too. So here, big climax run, higher highs throughout. This is called preliminary supply, and this should worry us, because look at this. Look at what happens after the preliminary supply. Big bout of selling on volume. So this is a big warning, and we see the market then collect itself, go back up. This is a very long trend channel. So this trend channel goes way, way back in time. And look at how well it worked. This is a definition of overbought of the trend channel. Now look here. Rallies up, jumps through the climax area, has a gap at the end, and builds a buying climax, and then we have an automatic reaction. Quick, sharp reaction. We draw resistance, we draw support. We do that right away. And then we can see secondary test, sign of weakness in phase B, an up thrust. I mean, all the things we just looked at. And so here, look at this. Look at the volatility. Look at this huge gap as it goes back down. So this is the thing that we look for. Volatility is high, it's higher, and then we have this march up to a new high, which is above this resistance area. And let's look at the volume during here. So the volume is not particularly high as it's going up here, so making Tom's point. And then as we get up to the area of the peak, we can see here that the volume starts to expand. And so we can see that there's a little climax bar here, a secondary test, and then a right-of-way weakness back into the trading range. And we'd say this is a distribution on a minor scale. So, and then we do a point figure count, and here's the phases. And so we can see all the phases are present. Phase E is going into the markdown. So here is the chart. This is in the blog. So look at this. So we have this very well-defined accumulation area. So this is a reaccumulation. Counts 180 to 193, goes exactly to 180 on the up thrust, and then it builds a small count. This is just a trading count. So for people that like to swing trade or small, just trades the tighter time frames, here it is, and it goes right to 157, 152, and I won't dwell on this, but it went right to 152, and then turned around and rallied right off of that and went back to the highs. So there's just a small example. Now here's a really big example, and this was the blog I wrote last week. And excuse me for going fast because I want to get my anatomy of a trade in here before we finish. And this is kind of my case study that I want to focus on because I think it's just a remarkably good case study. Now, I like to campaign stocks. So just to be clear about sort of my preference is that I like to do these things. I like to catch these big trends that go up and up and up and up. And so this is my preference. So you look for accumulation, this is the schematic we saw in the first slide. We see that there's a big cause being built. We can count with point figure, which is I have that chart, but for now, the high is 115.71, and at the up thrust, it goes to like 118, and then turns right off of that. So it did a really good job of telling us that how much fuel is in the tank, big uptrend, a lot of potential, had a really good move, great campaign, and then look what happens. This is a more than a year-long distribution that is like the schematic we just looked at with an upthrust at the end. This is one of the biggest and most beautiful examples that I've seen. So I thought, well, let's look at this and just kind of put the pieces together. So here's all the markups for this, but I am going to, unless there's any questions. So here's the point figure count, just so you can see it. And then here we're going into a daily chart where you can see this much closer because there's a couple of big points we can make about this. So look at this buying climax. Look at this march up, throws over the big trend channel, buying climax, and then we get a break. Look at the volume that comes in on the buying climax, and then the volume off the peak. So the volume kind of dries up, which is actually a good sign for more rally. So we have an automatic reaction. We draw resistance and support. Then it makes a secondary test, and this is an example of thinking about what the market could do here. The market could go up on the secondary test and go to a higher high than what occurred here. So it's entirely possible. And then we see that the volatility here is not really greater than the volatility here on this break. But notice this, after this upthrust in B, notice how the market gaps down, consolidates on the resistance, and then has another break. This decline is bigger than this, and arguably bigger than this. So the volatility is increasing. This is a sign of the CO's footprints selling stock. Now look at another upthrust. So look how cruel this is. Just continues to make higher highs throughout. And so then we have a rally that goes up, takes out this high, which is a form of resistance, has a climax, and then look at this break as it comes back in. So clearly there's no support for this as it breaks, and then this decline from here to what we call, this is like a minor sign of weakness because it undercuts these lows. And then and that should set up support here and here for another rally. So this rally is really, even though I wouldn't describe it as a great rally, has a lot of ups and downs, a lot of pullbacks as it goes up, but it goes up and up and up, and then has a climax at the end. And for the most aggressive of the short seller types, well, and this is where the point figure chart, the highest peak of the point figure chart, which was 115. So this is an upthrust, a minor test, a break. This breaks the trend channel, comes back up for a test, and it tests the trend channel. These are classic places for the short sellers to short if they're really aggressive. Short in here, just put your stop above this high with the expectation it's not going to get above that. So here you have this is the break that's the tell for poker players out there. You're looking for the tell. This is it. And that is this decline from here back into the range. And once you get back into the range, you've just given up an important sort of a psychological position in the stock. And so this resistance should now be in full force. And so in my case, full disclosure, I did short it at the LPSY as it tried to rally back above this area. I did not short it up here. And then this is the phase D decline, phase E big downtrend. And so here you can see effectively this downtrend went to $30. So yeah, go ahead.
I was just going to say a big decline, even though you didn't get at the very top, and that's hard in the market to try and catch the very top or the very bottom on a stock. I let everyone else try to do that. You still got it at a really good time. I tell you what, when you got there in February of 2012, when you initiated that short, where would you have put a stop?
The stop, I put the trade on right on this LPSY. I just had to pick a place here because there's really no good point. And so what I did is I put it above the gap.
Okay.
Yeah, at 100.
Yep.
But the thing is like, so for instance, and this is the way you have to look at it, is that all of this is cause for a big decline. So let's say you got the trade off here. This would have been an excellent entry place. And you would have put your stop above the LPSY. This is last point of supply. So this is the last point where supply is met, supply being selling before the downtrend occurs.
Gotcha.
And yeah, so it's just a Wyckoff term. And and then down we go. So this was just, I thought, one of the really great case studies because all the elements are in this. And also it deals with sort of the fog of trading. Now here's another one. Here you can see big trend channel, Netflix, this is 2011. This is sort of our tell in that we have preliminary supply here. We throw over here, this is overbought, comes back, so we just automatically draw a trading range. It kind of really mimics what happened with Decker. So it goes up thrust, up thrust after distribution, and then look at the volume come in. So what's the tell for us? So we're watching this take place. Well, the big tell is when we start to get a break off this climax peak on volume. And there's just this persistent drop that comes back down through the resistance area. As soon as it gets back into the below the resistance area, we know that the stock is effectively compromised, and it's in a weak position. And so we then look at this and go, oh, this is all distribution. And I see this all the time, is distribution occurring in the final leg up. This happens a lot, and it's very tricky business. And so here is my daily chart, anatomy of a trade. These are the trades. So I put in the pre-split price and the post-split price, and I did it in 2 tranches. And so here's the buying climax. So this becomes a lot more relevant when you put on a daily chart. You can see it better. And so you can see buying climax, automatic reaction. This is a pretty big reaction, preliminary supply, the biggest reaction that we can see on the chart. So we say, oh, this is a change of behavior. Volume is expanding. Volume's a little muted here because of these big bars over here, but big correction, buying climax, automatic reaction, support, resistance. Secondary test goes up to the prior peak. Well, look at this. This is interesting. It stays up here, and then it has an up thrust, and it comes back to old resistance, which actually looks pretty constructive. And this is the hard part, because momentum traders, and this is the reason I decided to do the up thrust after distribution, is that momentum traders are caught by this. And this typically always happens when you get into a big, strong, uptrending market. So it's just really a ripping market. The last leg up or the last move is going to typically be to a new high, and that will be often an upthrust after distribution. Exactly what happens here. This is a big, beautiful uptrend, has an upthrust after distribution, and then it just starts to persistently fall. It comes down and falls into the trading range area again. And so now the stock is compromised by this really persistent selling. You can see that Netflix is really for sale here. This is right when they went from DVD to streaming as their business model. And so there was kind of a hiccup in sort of the revenue stream and business plan and all that. And so that's sort of the reason behind it. But, not that I would have necessarily understood that at the time. I'm just trading off the chart. But here's like an important sort of a clue. It comes back into the trading range and then it rallies up to the resistance where the buying climax is. This buying climax resistance is the place where the selling starts in earnest. So the selling is persistent off that buying climax peak. The CO has said, this is where I'm going to start selling stock. The CO sees that this is profoundly weak now. They are going to be happy to sell stock at this level. And so this is a place where there should be formidable resistance. So this is the place that I put my first position on. And so I put it on at on this date and at 240.55. And then after that, it fell further into the trading range. And then it rallied up into an LPSY. So this is a break of this support area. So we call this a minor sign of weakness. And then it rallied up, and I was 1 day early. So this resistance line, I sold the resistance line, and it had one kind of a little climax bar the next day, turned back down off of that, and then the markdown began in earnest.
Very, very interesting. I actually have another chart of Netflix going back to that time frame that I would love to show as well. I think because the timing all fits perfectly together. We talk a lot about relative strength. So can I just show this chart quickly?
Absolutely, yeah, please.
Now this is a chart from 2010 to through 2011. So it's a 2-year daily chart. And you were just talking about your trades being over here in the August-September time frame. And you can see that, first of all, I didn't draw a trend line, but the uptrend in Netflix probably ended back in about July when it started making these moves to the downside. And you can see a few things. Number one, check out the 20-day moving average, which moves below the 50. And we struggle to get back up through that. And then also, I know Greg Schnell comes on here a lot, talks about relative strength. Look at Netflix relative to the S&P 500 for about 18 months here. Beautiful uptrend line. So the relative strength was there. And about the time you got into those shorts, the August and September timeframe is when, on a relative basis, Netflix fell apart. So there's a lot of different ways to angle into these positions. And I find, the Wyckoff discussion very, very interesting, given all the other signals that were present at that time as well.
I think what I like, this is a fabulous chart, by the way, and I've always loved to look at relative strength. So this is a beautiful relative strength chart, and I've always liked Wyckoff because it really does a good job of sort of defining the entry and the exit points, and so it does a good job of sort of like drilling in and being very specific. It's like, okay, this is the low risk point where you can put a trade on, put your stop above it, and there's going to be a very low likelihood the stop will get hit. And I love that, and I need that.
Yeah.
So
I think we all need that.
Yeah, but like for instance, how you manage like gaps in charts, it's the same kind of idea.
Yep.
Very specific.
Yep. Yeah, it was great having you on here. A very, very informative session. Really appreciate you coming on, and we're going to get you back.
Sure.